Good morning, friends. Today's topic might catch many of you unaware of certain provisions in law and might give clarity to rest who are aware of such provisions. Wondering what we are going to discuss today? So let me tell you. TDS deduction seems to be still very confusing and challenging for many NGOs due to various limits and rates prescribed in the Income Tax Act. We keep on getting queries from all corners of the country related to TDS deduction. I am Ashish Agarwal from Team NGO Enabler, and today I am starting a series of videos on some important sections of TDS to bring more clarity and understanding on when to deduct TDS and at what rates and on which amount the deduction should be made. The series shall continue unless there comes any other important updates or amendments related to NGOs during the interim period. So today I will discuss on the very first section of TDS, that is TDS on salary. TDS on salary has been very confusing and difficult for many, especially NGOs who usually are not so conversant with the laws. Many of them are still under a disbelief that no TDS has to be deducted on salary, as tax is the liability of the individual receiving salary, but it is not so. So today I will try to cover all the aspects related to TDS on salary and provide you with a practical derivation of the same once I have completed explaining all its aspects. So let's begin. TDS on payment to contractors, rent, professionals, etc. are comparatively easy to understand given the specified rate in the prescribed sections of the Act. However, Section 192, which lays down provisions for TDS deduction on payment of salary, does not specify any fixed rate but depends on the income tax slab rate prescribed for individuals, and thus becomes difficult to comprehend and calculate. I will try to ensure that post watching this video, this task too will become easy and smooth for my viewers. What also makes Section 192 different from other sections of TDS is in almost all the sections, TDS have to be deducted on payment or accrual, whichever is earlier. I repeat, in almost all the sections, TDS have to be deducted on payment or accrual, whichever is earlier. But under this section, TDS have to be deducted only on payment basis. So what should be the first step to be taken by an organization in order to compute how much TDS have to be deducted from payment of salary? First and foremost, an employee declaration form. I repeat, first and foremost, an employee declaration form, the format of which is enclosed in the description below, should be printed and sent to each employee for providing the following details related to their tax saving and other investments. First, investments made in accordance with Section 80C of the Income Tax Act, such as payment of LIC premium, deposit in PPF, deposit in fixed assets or post office savings scheme for more than 5 years, tuition fees of children, which is deducted only up to maximum of 2 children, unit linked insurance plan, tax saver mutual funds, and many more. Remember, the aggregate limit of deduction allowed under Section 80C for all the combined allowable investments after considering all these is only up to rupees 1,50,000. Second, payment towards health insurance or mediclaim of the employee and of its family. Such payment are deductible under Section 80D. The limit of deduction allowed under Section 80D is rupees 25,000 for own self, spouse and children, and rupees 25,000 in aggregate for the dependent parents. Don't forget to ask or mention in the form whether the employee's parents are senior citizens, because in that case the limit shall increase to rupees 30,000. Next comes payment towards National Pension Scheme under Section 80CCD Clause 1B. Although NPS is also covered under Section 80C, but with the budget 2015, an additional deduction of rupees 50,000 was allowed for contributions made by individual taxpayers towards the scheme. Next comes repayment of principal amount of home loan, if any. However, such payment shall be covered under the limit of Section 80C of rupees 1,50,000 as already discussed above. Then comes the repayment of interest on loan taken for higher studies from a bank or financial institution which is located in India or abroad, deductible under section 80E. The same can be availed against the loan taken for his or her own studies or for their spouse or children. So interest on loan taken for the higher studies of himself or herself or their spouse or their children is deductible under section 80E. Last comes the payment of donation to any organization registered under section 80G of the Income Tax Act. The amount of deduction has to be computed based on the various limits prescribed in the section. And details of many more such investments and payments have to be taken which are tax deductible in nature as per the provisions of income tax. It is to be noted that such employee declaration form should usually be taken at the beginning of the financial year. Want to know why? If one carefully reads section 192, the TDS on salary should actually be deducted every month at the time of payment. Therefore, it is pertinent for the organization to estimate the total amount of tax liable to be deducted at the beginning of the year based on the salary structure of the employee and the details mentioned in the declaration form, and spread the deduction over the entire year by dividing the amount into 12 months. Second step that the organization needs to take is all the employees should be asked to submit the documentary evidences in support of above investments or payments which might be in the form of payment receipt or the policy documents. Based on such documentary evidences only, the organization shall provide the necessary tax benefit to the employee while calculating his or her TDS to be deducted from the payment of salary as per the provisions laid down in section 192. Thirdly, in case of employees who are residing on rent, the copy of rent receipts, preferably with the rent agreement, should also be asked to be submitted by the employee for proper calculation of providing HRA exemption under section 1013A. The limit of exemption is 50% of basic salary in case of metro cities and 40% in case of non-metro cities, actual HRA received, rent paid minus 10% of basic salary. The PAN of the landlord is also mandatory to be quoted on the receipt in case the amount of rent exceeds rupees 1 lakh annually. Last comes the computation of income has to be prepared and income tax thereon has to be calculated for each employee based on the salary structure and the declaration so submitted. So now let's move on to the practical derivation of the computation of TDS on salary. First and foremost, I feel all of you must be aware of the income tax slab applicable for individuals. It is the choice of the individual based on his or her other sources of income and investments and many other factors to choose between the old or the new taxation regime. So the old taxation regime and the new taxation regime is on the screen there for you to calculate the rate of taxes on your salary. So I think all of you must have gone through the old taxation slab and the new taxation slab. Now suppose Mr. A is an employee in ABC Foundation and have the gross salary structure of rupees 12 lakh per annum. He pays annual premium of rupees 90,000 to LIC, rupees 15,000 as medical insurance, rupees 50,000 in PPF. He have also invested in NPS under section 80CCD amounting to rupees 50,000. So let's check the taxation under both the regimes. So you can see on the screen, under the old regime, the salary remains the same under the old as well as the new regime. The HRA exemption as per the calculation, suppose it comes to rupees 60,000 under the old regime, but under the new regime, no exemption can be claimed. Then there is a standard deduction of rupees 50,000 which is not allowed under the new regime. So the net salary under the old regime is 10,90,000 and the taxable salary under the new regime is rupees 12 lakh. Now comes the deduction under section 80 which is not at all allowed under the new regime, but under the old regime the employee PF is rupees 21,600, LIC premium rupees 90,000, PPF rupees 50,000, but the total deduction is restricted to rupees 1,50,000. So you can see the total comes to 1,61,600, but we have restricted it to rupees 1,50,000 because the limit under section 80C is only up to rupees 1,50,000. Then comes the deduction of NPS under section 80CC subsection 2, which is rupees 50,000, and this is the deduction which is allowed both in the old regime as well as the new regime. So now the taxable salary under the old regime is, after all the deductions, is rupees 8,75,000, and under the new regime it still is rupees 11,50,000. Now comes the calculation of tax. So tax as per the old slab will come to rupees 87,500. On first rupees 2,50,000 it is nil. From 2.5 lakh to 5 lakh at the rate of 5% will come to rupees 12,500. From rupees 5 lakh to 10 lakh at the rate of 20% will come to rupees 75,000. So the total tax under the old slab is rupees 87,500. Now comes under tax calculation under the new regime. On first rupees 2,50,000 it's nil. From 2.5 lakh to 5 lakh it's 12,500. From 5 lakh to 7.5 lakh at the rate of 10% it's 25,000. From 7.5 lakh to 10 lakh at the rate of 15% is 37,500. And from 10 lakh to 12.5 lakh at the rate of 20% will come to rupees 30,000. So the total tax is rupees 1,05,000. Now when you spread it over the period of 12 months under the old regime, you should be deducting rupees 7,291 approximately each month. And under the new regime, you should be deducting rupees 8,750 every month. So this is the procedure for calculating TDS on salary. I understand maybe a single example might not be sufficient enough and more such practical derivations might be of a little more help. But I hope you all must have at least understood the concept and steps for computing the tax to be deducted at source while payment of salary to your employees. Let me repeat the steps to be done. First, you need to take an employee declaration confirming all the tax saving investments done by them. You have to take the HRA receipts, the rent receipts for HRA calculations. Then you have to calculate the tax as per the slabs. Now what is the slab? How to calculate the tax and the taxable salary? Take the total salary, whatever payment you have to make to your employees. Then calculate the total investments which he has done. Give them the standard deduction based on whether they are under the old regime or the new regime. Calculate the HRA exemptions, and then coming to the slabs, calculate the tax as per the old slabs if they have opted for the old regime. Calculate the tax as per the new slab if they have opted for the new taxation regime. Whatever total comes as a tax amount, spread it over a period of 12 months and start deducting it from the very first month. For more such tutorials, keep subscribed to our YouTube channel, and for any queries you can mail or comment below. Thank you.